will now look at computation of total income and tax liability, and first we look at computation of tax payable or refundable. What are the steps in brief? We determine the tax on total income. We allow rebate under 87A if available, or we add surcharge if applicable, adjusted for marginal relief if applicable. To the balance, that is tax minus rebate or tax plus surcharge, we add HEC at the rate of 4%. Then we reduce AMT credit under section 115 JD, AMT alternate minimum tax, which we will now look at in some time, as well as relief under section 89 if it is available. We add interest under section 234A, 234B, 234C, and or fees under section 234F. This gives us the amount of tax liability. That is the liability in respect of tax for the SSE. In order to arrive at the tax payable or refundable, we need to reduce the prepaid taxes on account of TDS or TCS or advance tax. This tax payable or refundable is rounded off in the same way as total income. This is what we have already looked at in the topic on basic concepts at the beginning of this video. Now you need to note that tax liability is not the same as tax payable or refundable. Tax liability is the liability of the SSE. Tax payable or refundable is what the SSE finally needs to pay or the amount that needs to be refunded. Therefore, if the question asks for tax liability, there is no need to adjust prepaid taxes. But if the question asks you to determine tax payable or refundable, then you need to compute tax liability, then you need to identify the prepaid taxes and adjust those prepaid taxes to arrive at the amount of tax payable or refundable. We will now look at the provisions of alternate minimum tax or AMT. The relevant sections are 115 JC to 115 JF. Applicability of AMT. The provisions of AMT apply to a person other than a company. So AMT doesn't apply to a company. Different provision is applicable to a company, but that is not relevant for CA Intermediate syllabus. So AMT applies to a person who satisfies all of the following three conditions. 1. The person has claimed any deduction under the following provisions, and there are three of them. 1. Chapter VIAC, but other than section 80P. That means it includes 80JJAA, 80QQB, and 80RRB. This is what we have discussed some time back on account of deductions from gross total income. Certain other sections are also included in chapter VIAC apart from these, but those are not relevant at CA Inter level. So for us, what is relevant is to see whether the person has claimed 80JJAA, 80QQB or 80RRB, or deduction under section 10AA for newly established units in SEZ, or under section 35AD, tax incentives under section 35AD, the deduction that we saw in the topic on PGBP. So this is the first condition. The second condition is that the adjusted total income of the person is more than rupees 20 lakh. But this condition applies only to an individual HUF, AOP, BOI, AJP, artificial juridical person. So it doesn't apply to, say, for example, a firm. And number 3, the person has not exercised the option under section 115 BAC in the case of individual HUF. This is something that we will note in some time shortly. Or under section 115 BAD in case of cooperative society, right? So these three conditions need to be satisfied. Deduction should not be claimed under any of these provisions. ATI should be more than 20 lakh. And 115 BAC option should not have been exercised by the person. So the question is, what is the meaning of adjusted total income? Adjusted total income is the total income adjusted on certain counts. So first we determine the amount of total income. Then, as we noted above, the person should not have claimed deductions under any of these provisions. So if the deduction has been claimed, we add back. So we add deductions claimed, if any, under 80JJAA, 80QQB, 80RRB, 10AA and 35AD. Now, as far as 35AD is concerned, if we add back the deduction, then in its place, we should now allow the depreciation under section 32, as if no deduction under 35AD was allowed. Because if 35AD is not allowed, depreciation should be allowed. So when we are adding back 3580, we should now provide deduction on account of depreciation under section 32. And this gives us the amount of adjusted total income or ATI, which as we noted above should be more than rupees 20 lakh. Now if these applicability conditions are satisfied, then we need to proceed to the computation of AMT. And there are 3 steps. Step 1. First we compute the regular tax payable for the previous year, which is what? Which is tax on the regular total income plus applicable surcharge and HEC. Second, we compute the AMT payable for such previous year, which is what? Which is 18.5% of the adjusted total income plus applicable surcharge and HEC. This rate of 18.5% is 15% in the case of a cooperative society. Then we compare regular tax and AMT. If regular tax is less than AMT, not more. If regular tax is more than AMT, then regular tax is payable, AMT is not payable. But if regular tax is less than AMT, then ATI is deemed to be the total income of the person for the previous year, and consequently the person is liable to pay AMT instead of the regular tax. So ATI is deemed to be the total income. So what happens to incomes taxable at special rate, for example capital gains? They get assimilated within the ATI, hence such incomes are not taxable at their respective special rates. Rather, AMT is computed at the rate of 18.5% of ATI. Surcharge and HEC rate for computing AMT liability is the same as that for computing regular tax liability. This is what we have noted in the topic on rates of tax. We also noted there that there is a 15% limit on the rate of surcharge on tax on what? Dividend and capital gains taxable at special rates 111A and LTCG under 112A and 112 as well. Right? But this 15% limit is not applicable while computing AMT. Now AMT credit is available to an SSE. AMT credit is also available. And what is the amount of AMT credit for an assessment year? It is AMT paid minus regular tax payable. So the tax which is paid as AMT, which is in excess of the regular tax, that becomes a credit which is carried forward to the subsequent assessment year. And then it can be set off in an assessment year in which regular tax is more than AMT, right? So where regular tax is more than AMT, to the extent of such excess, the credit can be set off. What about the balance? The balance is then carried forward, and it can be so carried forward for a period of 15 assessment years. But note that no interest is payable on AMT credit. Okay. Now, AMT credit cannot be set off against the tax liability computed under section 115 BAC in the case of individual or HUF, or 115 BAD in the case of cooperative society. AMT credit cannot be set off against the 115 BAC tax liability. We will now cover the provisions of section 115 BAC, which provide for a concessional rate of tax for individuals and HUF. Concessional tax rates. Under this provision 115 BAC, the tax on total income of individual or HUF is covered, is computed at concessional rates given below, as you can see, at the option of such person. So 115 BAC is not compulsory, it is optional. Now if you look at this table, this is the range of total income. These are the 115 BAC rates of tax, and these are the regular rates of tax which we have already noted in the topic on rates of tax. And as we noted there, the individual or HUF can be categorized as a normal case, or as a senior citizen, or as a super senior citizen. In normal case, the basic exemption limit is 2,50,000, and then the slab rates of 5% or 20% or 30% are applicable. For a senior citizen, there is basic exemption limit of 3 lakh, and then the slab rates of 5% or 20 or 30% apply. In case of super senior citizen, there is the basic exemption limit of 5 lakh, and then rate of 20% or 30% apply. As against this, the rates of tax under 115 BAC are uniform, as you can see here, for normal case, senior citizen case, as well as super senior citizen case, and the basic exemption limit for everyone is 2,50,000. So there is no tax up to 2,50,000. And then the rates of tax increase with 5%. So 5, 10, 15, 20, 25 and 30%. And you would note that the 5% increase is with the increase of total income by every 2,50,000. So up to 2,50,000, more than 2,50,000 and up to 5 lakh, more than 5 lakh and up to 7.5 lakh, and then 10 lakh, 12.5 lakh, 15 lakh and more than 15 lakh. So an easy way to remember the rates of tax under 115 BAC is that you increase the total income. You start from 0 and increase it by 2.5 lakh, right? And start with the 0 rate of tax and increase the rate by 5% at every level. So this is how the rates of tax have been prescribed under 115 BAC. Now certain points that we need to note. As we noted above, rates of tax as well as basic exemption limit is uniform for everyone under 115 BAC in all these three categories. What about incomes taxable at special rates? For example, short-term capital gain under 111A 15% or LTCG under 112 20% and 112A 10%, winnings, undisclosed incomes. What about these? They continue to be taxable at their special rates under the 115 BAC regime as well. The normal income is taxable at 115 BAC rates. So what happens is that special incomes continue to be taxable at their special rates while the normal income gets taxed under 115 BAC rates instead of the regular rates of tax. Rebate under 87A is available on the tax computed under 115 BAC and the position doesn't change. What about surcharge? Here also the position doesn't change. It is applicable at their regular rates and adjusted for marginal relief if available. And therefore the surcharge on tax on dividend and STCG under 111A and LTCG under 112 or 112A cannot exceed 15%. So the position remains the same as we have noted in the topic on rates of tax as far as the regular provisions are concerned. What about health and education says it is applicable at the regular rate of 4%. There are certain conditions to be satisfied for availing the concessional rates of tax under section 115 BAC, and now we will look at these conditions. So condition number 1, the total income should be computed without allowing the exemptions and deductions which are listed below in the table. So these are not allowed, the assessee cannot avail. That's why the government wants the assessee to forego these exemptions and deductions, and consequently the government provides the benefit of a concessional rate of tax to the assessee. So we will look at each head of income. First, income under the head salaries. Exemption in respect of leave travel concession is not allowed. Exemption in respect of HRA is not allowed. Then exemption in respect of special allowances is not allowed, except the following 4 items, in which case it is allowed. What are these 4 items? Traveling allowance for tour or transfer, daily allowance for tour or transfer, conveyance allowance for tour or transfer, and disabled conveyance allowance. All of these we have noted in the topic on salaries. 1, 2 and 3 are allowed exemption to the extent the expenses are actually incurred for the purpose for which allowance is granted. So that means to the extent of official expenses. And as we have noted, disabled conveyance allowance is exempt up to 3,200 per month. So these 4 are allowed, but all other special allowances under section 1014 like children education allowance, children hostel allowance, etc. are not allowed. As far as free food and non-alcoholic beverages provided by the employer is concerned through paid vouchers, we have noted there is an exemption given of ₹50 per meal. This is not allowed. All the 3 deductions under section 16 are not allowed. Standard deduction, deduction for entertainment allowance, and deduction for professional tax. What about income under the head income from house property? 24B deduction is not allowed. What is this? Interest on borrowed capital in respect of SOP or UOP. SOP or UOP, interest on borrowed capital is not allowed. What this means is that interest on borrowed capital in respect of LOP or DLOP is allowed. So SOP, UOP, interest is not allowed. LOP, DLOP, it is allowed. Profits and gains of business or profession. Deduction under section 10AA for newly established units in SEZ is not allowed. Depreciation. Additional depreciation is not allowed. 32(1) 2IA. That means normal depreciation is allowed. Section 35 for scientific research. Payment to specified entities for scientific research or statistical research or research in social sciences, right, is not allowed. What this means is that deduction for in-house expenditure on scientific research is allowed. 35AD deduction, investment linked tax incentive for specified businesses, it is not allowed. Now since 35AD is not allowed, as a corollary, normal depreciation on capital expenditure that would otherwise have been allowed under 35AD should now be allowed. So if 35AD is not allowed, the normal depreciation should be allowed. 35CCC deduction for expenditure on notified agricultural extension project is not allowed. What about income from other sources? As far as remuneration of an MP or MLA is concerned, daily allowance and constituency allowance is exempt under section 1017 as we have noted before, but this exemption is not allowed. What about family pension? Standard deduction is allowed of lower of 1/3 of such income or rupees 15,000, but it is not allowed under 115 BAC. What about clubbing of income? In respect of income of minor child, exemption of rupees 1,500 per minor child under section 1032, it is not allowed. What about deduction from gross total income? No deduction is allowed except for two deductions. Only two deductions are allowed. So we noted under section 80 CCD, employer's contribution to NPS or APY is allowed under section 80 CCD 2. Not employee's contribution, employer's contribution, that is allowed. And 80 JJAA on account of employment of new employees, this is also allowed. All other deductions from chapter VIA in computing gross total income are not supposed to be allowed. So this was condition 1. Now we look at condition 2. Condition 2 is that the total income should be computed without set off of the following loss. So these losses cannot be set off. They are not allowed to be set off. And what are these? Number 1, set off of any loss that is carried forward or unabsorbed additional depreciation, right? Because additional depreciation is not allowed under section 115 BAC. Normal depreciation is allowed. So the loss that is not allowed to be set off is what? Set off of any loss that is carried forward or unabsorbed additional depreciation from any earlier assessment year. But what is the condition? The condition is that it should be attributable to any of the deduction which is not allowed in computing 115 BAC. That means if there is a loss which has been carried forward or unabsorbed additional depreciation which has been carried forward, that means it is brought forward and it is attributable to any of these items or the list of deduction that we have seen that is not allowed in computing 115 BAC total income, then set off of such loss is not allowed. The logic is that if the deduction is not allowed, then if the loss has arisen on account of such deduction which is brought forward, that loss should also not be allowed to be set off. Correct? Second, set off of any loss under the head income from house property is not allowed with any other head of income. That means inter-head set off. Inter-head set off of loss under the head income from house property is not allowed. Now, as far as loss on account of SOP or UOP is concerned, there is a limit of 2 lakh, right? But as we have noted above, interest on borrowed capital in respect of SOP, UOP is not allowed. So therefore, when computing 115 BAC income, loss will not arise in respect of SOP or UOP. But interest is allowable in respect of LOP or DLOP interest. So loss in respect of LOP or DLOP can arise. Right? Now, inter-head set off of such loss is not allowed. Inter-head set off of such loss is not allowed, which means that intra-head set off within the head income from house property is allowed, it is not barred. Similarly, carry forward of unabsorbed loss, right, under section 71B is also not barred, that is also allowed. Now we look at condition 3. Now normal depreciation is allowed, additional depreciation is not allowed. Normal depreciation is allowed in computing 115 BAC income as we noted above. Now, when we allow normal depreciation on the WDV of a block of assets, the condition is that the rate of such depreciation is limited to 40%. So the rate that is applied should not exceed 40%. The last condition is that total income should be computed without any exemption or deduction for allowance or perquisite provided under any other law for the time being in force. So these four conditions need to be satisfied, in which case concessional rate of tax can be computed on the total income computed under section 115 BSE. Now, as we noted above, the provision is optional. So the option needs to be exercised. What is the manner in which option is to be exercised? We will see. It depends on whether the person is having income from business or profession, or is the person any other person. That means, is the person having PGBP income or not having PGBP income. If the person is having income from business or profession, then when should the option be exercised? On or before the due date under section 139(1) for furnishing return for any previous year. So this option needs to be exercised once. Okay, not every year. Once this option is exercised, it applies to subsequent previous years as well. Now the option gets invalidated in certain situation. What is that? It is a situation where the person fails to satisfy the above stated conditions for applicability of 115 BSE. These four conditions that we noted above. If the person fails to satisfy for the previous year, the option becomes invalid. For which previous year? For that previous year of default as well as for subsequent previous years. In that case, for all these previous years, the regular provisions of the Act apply as if the option had not been exercised, so 115 BSE benefit cannot be availed of. In any other case where PGBP income is not there, then the option should be exercised when? It should be exercised along with the return to be furnished under 139(1) for that previous year. This means that the option needs to be exercised for each previous year, and therefore the option can change for each previous year. In 1 year, the person may want to exercise, in another previous year, the person may want to opt out. Now, when is the option invalidated in such case? If the person fails to satisfy the above stated four conditions for the previous year, the option becomes invalid in respect of that previous year for which it has been exercised. And in that case, so the invalidation happens for that previous year, not for the subsequent previous year, as was the case above. In such case, the regular provisions of the Act apply for that previous year, and 115 BSE concessional tax rates are not applicable. Now, in the case of PGBP income, we noted that option once exercised, it applies to subsequent previous years as well. So the question is there no provision for withdrawal of this option? So there is. Such option once exercised by a person having PGBP income can be withdrawn only once for a previous year. Only once, this is the limit. But not in the previous year in which the person has opted for. The option can be withdrawn only once for a previous year which is other than the year in which it was exercised. But there is now a restriction which becomes applicable. Once the option is withdrawn, then the person can never become eligible to exercise the option under section 115 BSE. So the option lapses forever. Okay, but there is an exception. The only exception is where such person ceases to have income from business or profession. If the person, so long as there is PGBP income, he is never eligible to exercise the option under section 115 BSE. But when PGBP income ceases, then the person moves from category 1 to category 2. From category 1 to category 2, in which case the provisions of category 2 starts to apply, and then in that case he can exercise the option every year.